Well, hello everyone, this is Vishal Sanjay of downmetalblogger.com. This is a second video blog and I've tried to improve a few things from the first one. And let's not waste too much time on this, and I want to get straight to business. A few months ago, a few of you would have seen one of my posts on the dot-com bubble. Um, Most of you disagreed with me that it's going to happen again. It did get a lot of attention, but most of the people who read it disagreed with me. But recently, Newsweek made a post on their site and they linked to my site, which was great. And even they claimed that there could be possibility of another dot-com bubble. This video blog concentrates on what the dot-com bubble was, what happened after that, and why it could repeat itself again. It all started off with a speculative bubble during the period from 1998 to 2000. Very soon it had grown too big and it just had to burst. The first reason given for this is too much investments in the dot-com industry, which saturated the market and obviously reduced returns for investors and overvaluated firms by a lot. But the actual problem which I think caused the burst was the change of attitude in entrepreneurs who came up during the 90s, that is. Most entrepreneurs started focusing on brand building and networking before even generating their first revenues. They also started free spending, which exploited all of the shareholders' money. All of these CEOs of such companies were sued after the burst, but this mentality was boosted by plenty of availability of funds and investors. The people of those times used to say that all you need was an idea and basic HTML in order to become a millionaire. That's true, because in that time, just by setting up a small site, you would have got venture capital and angel funding with no difficulty at all. The main idea here was to increase brand exposure and market share while running under an operating loss. They believed if they capture the market, they would be profitable in any way. The increasing fame of certain brands brought out more enthusiasm in the average investor to buy stocks of those companies. Basically, these companies advertised a lot. They were everywhere during that time. So the public image was high and investors got easily misled, and they never cared to look at the burning cash books of these companies. All of this had to come to an end, and in the beginning of 2000 the market crashed to a certain level. Many investors lost their money, and in a few months many publicly traded firms, internet firms, announced bankruptcy. This even affected the traditional self-funded businesses, as there was a huge decline in online spending, which resulted in the shutdown of more companies. It was estimated that about 30% of the internet firms survived the dot-com burst, and many of those which followed the traditional business model turned out to be majors in today's internet, which includes Google, Yahoo, eBay, and Amazon. So now, why do I think that this would happen again? Well, I myself am not sure about this, as I'm not any sort of a market analyst or anything, but a few instincts boosted by market trends makes me think that the dot-com bubble would surely reoccur. Many Silicon Valley VCs who themselves faced the bubble in the past predict the formation of another bubble. The main reason they gave is investors pouring in tons of money in web-based firms, taking their valuations to tens of millions of dollars, but which don't have any plans on providing returns. I personally hear of 3 to 4 startups a week on blogs such as TechCrunch and Mashable, which have raised millions of dollars in different rounds and have barely any method of monetization. Most of you here would have thought of Twitter as a grand success. Well, for users and Twitter fans, yeah, it is a grand success, but if you consider it as a business, or if you see it in the investor's point of view, you'll see that it's a failure. The reason is because Twitter has barely generated any revenues in the past 4 years, but it's raised about $1 billion in funding, and moreover now it's burning cash at the fastest rate. I don't know why they're doing this, but Twitter is surely not like the startups above. It's got multiple options to monetize itself, and it can also earn as much as Google if it really wants, but strangely they rarely use any monetization method. But this takes me back to the entrepreneurs of the 1990s. They felt that monetizing a site was like telling people to pay for a party. Well, let me remind you that if there's no money, there will be no party. And I think this attitude is again coming up among entrepreneurs very fast, and if this continues, we're surely headed towards another dot-com bubble. I made up a list of a few elements which actually contribute to a bubble, I mean the dot-com bubble. I'm afraid the list is too huge, so I'll be concentrating on some things which are the main actually. So the first thing, as I told about the overvaluation, which is again the same for the first dot-com bubble. Again, investors are pouring in tons of cash in firms which mean no returns. They're following new brands and ideas rather than new business and revenue models. Cisco, for an example, acquired two internet startups for reportedly $160 million, which I think is 10 times the actual market value, both of which are not yet known, not yet popular, and are restricted to a smaller niche and huge competition. Google is now valued at $152 billion, but it makes a profit of just $20 billion a year. That's like 55 times Google's share price. Facebook makes just $1 billion a year and is valued at $32 billion. According to my formulas and my strategies, a company must have a yearly income of at least 10% of its market value. And right now, you will surely not find any such firm. Too high valuations result in low returns, which will result in a sell-off during the long run, which is actually the main cause for bankruptcies and layoffs. Increase in free spending. My second on the list, that is, and that's actually boosted by overvaluation, and it actually causes a change of attitude in entrepreneurs once they get to know that they have tons of cash ready to be invested. In the past 1 year, internet firms have started spending in a huge rate, all of which provide no returns financially. This is basically on open source products, free communities, events, which is praiseworthy but not something expected by a firm's shareholder. Wall Street has been extremely skeptical about Google's increasing expenditure. The firm has hundreds of online services, but out of which only just 3 to 4 contribute to its financial gain. Everything else is just a way of giving back to the society and showing goodwill in the society. But Google has a lot of income. But what I am afraid of is startups with no revenues following this path. There are also many entrepreneurs out there who have no personal attachment to their firms. All they are interested in is taking huge salaries and bonuses and making themselves rich, just because they have very less investment of their own in their respective firms. External investors are ready to take on everything for way less. Retarded business models. I think this is third on my list, but this plays a key role in the dot-com bubble. Every week I come across startups which have raised over $10 million in different rounds, but less than 10% of them have a business model which makes sense. The basic idea behind these funds is to help gain a solid customer base and then find a way to monetize it. That's something which will never happen because many of these firms are in such niches which have too much competition or very less audience, or even if you have a lot of audience and less competition, you won't be able to monetize yourself. So a revenue model must always be thought of first, which never happens today. As I read through many press releases of startups, one thing I find is retarded business models. Their monetization methods are just senseless if you ask me. Just go to TechCrunch, Deadpool, and you'll find a handful of them. Today on the internet, there are basically two business models which are the foundations for a firm's business. One is advertising sales and the other is premium products and services. All business models are usually based on these, and highly successful are those which optimize and innovate on these two models. When I think of a new business idea, I first think about how are we monetizing it. Then I think about its elements, marketing and funding. I used to think that this was common for all startups, but unfortunately I was very wrong when I spoke to a few other entrepreneurs and other startup enthusiasts. The last thing on my list is being part of small and dependable niches. I know there are many companies out there which solely earn their revenues from iPhone, iPad and other Apple products by developing apps, which I seriously oppose. If you're an individual developer and you just develop an app for passive income, that's fine, do it. But if you're a company, if you have hundreds of employees and if you take hundreds of thousands of dollars in funding, it's not a good idea to depend on one single company for the sole revenue. Till now, Apple has been loyal to its developers and most of them have made good money. But for Twitter, take example of Twitter. There are almost like 100,000 third-party Twitter apps now, and some like Hootsuite, Bit.ly. Hootsuite is still profitable, I agree, but they were affected a bit when Twitter introduced their own stats system. But Bit.ly was badly affected when Twitter introduced its own URL shortening service. Twitter now is not trustable by third-party apps, and both Hootsuite and Bit.ly are individual companies which are solely dependent on Twitter. So I advise you to be part of multiple niches. If you are part of a social media niche, that's fine. Don't be part of only Twitter. Earn money through Twitter, Facebook, and other social media sites. That's okay, and nobody cares about that. But if you're taking funds, I mean, if you're investing in such companies, I ask you to be really cautious, because you never know. You can never trust a private company. They just want to make money themselves. They don't care about you. And how can you build a company over that? That's what I want to ask. Well, I cannot guarantee about this so-called dot-com bubble thing, but I can tell you that in the previous dot-com bubble, companies like Google, eBay, Yahoo, and Amazon got out and successfully became internet majors because their business and revenue models were different from others. Moreover, they eyed profits more than growth. That's what I advise you to do. Eye on the return on investments rather than getting more investments. That's what I can say. Moreover, thanks a lot for watching this video, and I also urge you to subscribe to our YouTube channel and follow us on Twitter as well. And if you visit my blog www.dumblittleblogger.com, I'm sure you'll find more videos, articles, and tips on making money online, developing your internet business, and marketing on the internet. Thank you for watching. Yes.